Good evening, everyone. I hope I can be heard. Welcome to the Investor Forum of Hatton National Bank for 2021. As usually done, I'll go through the presentation in 10 minutes, 10 to 15 minutes, and thereafter I'll open it up for questions. So the first slide that you all can see, you see that the net interest income for the bank and the group has grown by 11% overall, going up to 56.5 billion. However, interest income saw a 5% drop. The main reason for this was despite the loan book and interest earning assets growing, the AWPLR, or the interest rate in the economy, was around 160 basis points below on average in 2021 compared to what we saw in 2020. So that's the main reason why interest income actually witnessed a drop. Similarly, interest expenses also dropped by a much significant margin by almost 18%. And as a result, we saw NII growing by almost 5 billion. So if you look at overall loan growth, we witnessed a 15% growth in our loan book. There's 11% growth in our deposit book, and we surpassed the 1 trillion mark in our deposits. CASA did even better with a 15% growth, increase in our CASA ratio to 41%. And if you now start looking at NIMS, which is the bottom right-hand corner graph that you see, you'll see that NIMS started coming down from 2019 up to 2020 with interest rates moving down. But thereafter, you have seen it stabilizing in 2021. And now you will see NIMS starting to move up with interest rates going up. So now I said on average, AWPLR, or the prime weighted lending rate, was 160 basis points lower in 2021 compared to 2020. But since the interest rates started going up towards the latter part of 2021, up to now, we have seen AWPLR moving up by about 300 basis points. So this is going to have a significant positive impact on margins. Again, fees have also done pretty well. If you look at fees in 2020, we had a fairly bad year with economic activity getting affected due to COVID and the lockdowns. But from there on, we have seen that fees have grown by 28.5% to finish the year at 10.3 billion. So out of these fees, the main growth came from credit cards as well as trade. Despite trade, there have been restrictions on trade. We have seen a fairly good growth in trade-related fees in 2021. Mainly because in the early part of the year, there were no restrictions, or there were limited amount of restrictions, as well as we have seen the tariff levels also going up. So that has also helped to maintain the fee income coming from trade business. Then there's a significant jump in exchange income because the rupee depreciated by 7.5% in 2021. So that has resulted in a significant jump in exchange gains from 2.4 billion in 2020 to 5.8 billion in 2021. The insurance subsidiary has also done well. You see a 20% growth there, achieving a 10.6 billion. So moving on in terms of impairment, you'll see that overall the asset quality of the bank improved in 2021. So you'll see the NPA ratio, which was at 4.3% in 2020, improved to 3.38 or 3.4% in 2021. So it's almost about 100 basis points improvement in NPA. And the loans under moratorium, which were at around 40% in mid-2020, came below 10% or even as close to 5% at the end of 2021. So that even the other loans that are under impairment will slowly move out from January onwards, only leaving the loans given to the tourism sector, which will continue its moratoriums until June 2022. So therefore, you will see that even with some management overlays that we have brought in, the impairment on loans have come down from 12.4% that we had in 2020 down to 11.7 billion. So there is a drop that you see there. But that has got negated by a significant increase that we had to make on our sovereign and SLDB investments because of the sovereign downgrade from triple C to double C. So there you will see the impairment has increased from 2.9 billion to 7.1 billion. So as a result, total impairment has gone up to 18.8 billion from 15.3 billion. So even stage three loans, stage three loan ratio, you will see has come down from 3.4% to 2.6%. So then in terms of cost to income ratio, again, you'll see a sharp decline in the cost to income ratio from 39.3% to 34.4% for the bank, and for the group from 48.3% to 44.3%. But in these personal expenses, there was an exceptional adjustment that happened in the final quarter of the year, and that was because the retirement age was extended from 55 to 60. That had an impact on our pension liability. So the pension liability was readjusted and it came down by approximately 2.5 billion. So that adjustment is the reason why you'll see that the staff cost has actually witnessed a decline. So adjusting for this one-off adjustment, cost to income ratio still was lower compared to 2020 with the bank at 37.9% and the group at 47%. So going into taxes, you'll see that the effective tax rate has come down. The main reason for that is the corporate tax rate coming down from 28% to 24%. In addition to that, we were also able to settle some old tax returns, and there were some more provisions that we had made, which got reversed during this year. So as a result, total group PAT increased by 47% to 20 billion, and profit to equity holders to 19 billion. So then on ROE, you'll see that NII to average assets, other income to average assets, and cost to average assets and taxation to average assets all have contributed positively, while impairment, the credit cost has gone up slightly. Overall, the ROA improving from 1% to 1.4%, resulting in a ROE of 11.5%, increasing from 8.7%. So going into capital adequacy, HNB remains one of the most capitalized banks in the country with a 18.2% total capital adequacy ratio and 14.5% on tier 1. And also the LAR and the liquidity ratios also been fairly sound. So then going into dividends, we have declared a 9 rupees per share dividend for 2021, 1 rupee more than what we declared in 2020. Cash dividend stands at 650, giving a dividend yield of 6.7%, a total dividend yield of 6.7%, and a cash dividend yield of almost 5%. So with that, can I stop my presentation, and I'll be happy to take any questions. So one question that I see is what is the exposure to ISBs and SLDBs? Overall, we have an exposure of approximately $755 million at the moment, both to SLDBs and SLSBs. And expected loan growth for 2022 is around, well, we expect the industry to grow at around 15%. Given that inflation has also gone up, we expect that nominal GDP to be around 15%. So that's probably the area that we would expect, maybe between 15 to 20% growth on the loan book. So current loans under moratorium would be around 5% at the moment. So there was a question whether there is a higher provision in requirement given the current macroeconomy, but you have seen that we have taken a fair amount of management overlays into our provision. So that is over and above what the models would usually tell us to take. So we have stressed the scenarios, and based on those, we have taken in additional moratorium or additional impairment. But you would see that in general, the NPAs have been coming down. We have seen positive shift in the loan bucketing from stage 3 to stage 2 to stage 1. So based on those, we don't see that there was a significant need to take additional impairment, but still we have, because of some of the loans being under been under moratorium, but those loans are also, as I mentioned, have been coming out of moratorium and performing well. So total management overlays that we have taken up to now would be around about 8 billion. So for September, the PD was at 15%, which was increased to 30% in December. So the outlook for fee income has been positive. As I mentioned, even in the last 2 months, we have seen a fairly good take up in fee income, especially in credit cards. Even trade still has been performing fairly well. This is as a result of also a revision on tariffs. We have seen that all the fees, I'm not only talking about uh, trade and cards, but also even loan related fees, guarantees, all that has been performing fairly well. So we expect at least around a 20% growth this year as well. So the exposure to ISBs maturing in July is about $90 million. So what is my outlook for PLR? So my outlook on interest rates is that it should go up. Probably didn't expect the rates to jump so quickly the way it did in the last few months. But still, I would say there is definitely room for rates to go up further. So I'll expect AWPLR to pass 10% this year. And again, still might have a more room to for it to increase in 2023 as well. But it also depends on a lot of other factors. But at the moment, my expectation is for rates to further go up. So we had about, I believe, altogether over $100 million of ISBs and SLDBs that got matured in January itself. So on that, uh, we'll have about so close to about a 1.5 billion of reversals in impairment. So digitalization, so it'll have it's a long-term process. So digitalization has helped. When you say digitalization, I'll have two pillars on that. One is the use of technology to centralize processes. So earlier we had a lot of our activities done in the branches, and branches were like mini banks. So we were able to bring in technology and use technology to centralize various operations. So that has helped to bring down the cost to income ratio. So you would have associated HNB cost to income ratios at 50% not so long ago, bank wide. Those ratios have actually now come down to mid 30s. So that's a significant improvement that you have seen in cost to income ratios because of these centralizations that we have done using technology. Uh, so that has had a significant impact on improving ROEs, and it will continue to do so. The other aspect of digitalization is the customer facing digitalization, where you have your the mobile apps, the internet banking, the various other digital products that we have for customer convenience and custom requirements. So those are, you will see them being uh, uh, taken up fairly well, and probably the impact on ROE on those will probably accrue more into the future, and we probably have only touched the surface on really monetizing some of those initiatives. But of course, the ATM, which I'm not actually using as digital channel, has had a significant impact, because now 90% of the withdrawals of a bank happen through a machine and 70% of the deposits happen through a machine. So if you take ATMs also as a digitalization initiative, yes, that has had a significant impact already on the ROE. So that is for December quarter, why tax rate has come down is the reason that I mentioned. There were a few earlier tax assessments that we completed in 2021, which resulted in us having had the over provision on those tax assessments, which we were able to reverse. So that's the reason why December quarter you saw almost a zero effective tax rate. So NPLs of HNB Finance would be around 10% as of end of December. So as I mentioned earlier, again, the question is being asked about the tax rate in December. The reason is there were previous year tax assessments that we had got, for which we had already made provisions in the P&L in those years. Once we finalized the tax assessment and cleared it, we were able to clear it at rates lower than we had initially brought into the P&L. So there were reversals of those over provisions. So that's the reason. So the expectation is that NPA would not reduce. What we have experienced is that we have been able to contain NPAs extremely well. But I think that these 3 months is fairly crucial, because most of the loans that most of the key loans that moved out from moratoriums in the last few months. So we are managing it well. The feedback that we get is very positive at the moment. So there might be a slight uptick with some of those loans maybe going into NPA, but then I think from this quarter onwards, you wouldn't see terminology called NPA. What you will see is your stage 3 loans, and most of these loans, if we had already thought that they were they were problematic, even though they were under moratorium, we would have already classified it as stage 3 loans. So hence, you might not actually see a significant increase in stage 3 loans, because these would have already been brought in as stage 3 loans if we thought that there was an issue in some of those. However, the feedback that we have got from the front line, from the recoveries team, is very positive with regard to the final tranche of loans that came out of moratorium from January. So overall, dues to banks and foreign borrowings have come down. So that because you would have also seen that our investments in SLDBs, SLSBs have also been coming down, and we have been using those proceeds to pay off some of our borrowings. So both sides have actually come down. So a liquidity coverage ratio, I don't see a decline. It's fairly high, but of course, the high levels that you saw in 2020 has come down, because we had 40% of our asset book in liquid assets because there were not many opportunities to lend in 2020, but with the economy recovering in 2021, some of those liquid assets that were in treasury bill bonds got converted and went into loans. So, of course, the liquidity levels came down from 40% down to about 28%, but still it's very high compared to a minimum requirement of 20% on LAR. So no, we are not expecting too much of stress. Actually, almost all the sectors have done fairly well to really come out of the lockdowns and the moratoriums, and that you will see in most of the loan books in the banks where NPA ratios have improved significantly. And for us, you saw almost 100 basis points drop. So which means that most of our customers have done well to come out of moratoriums and revive their businesses. So haven't seen too much of an, I think most have done well, and we haven't seen too much of a stress. Okay, so you're talking about power interruption. So power interruption and the impact of SME, we probably haven't seen yet. Again, I believe there'll be a lot of resilience there as well. But for the moment, we haven't seen any major stresses or major issues that have come up where SMEs have been saying that they are unable to work or whatever. But let's see how long. So if this prolongs, then of course, yes, there would be, but depends on how long this issue is going to be there for. So if I may look at 2021, most segments actually draw the loan book. It started with the retail segment growing because interest rates were low. There were very good surge in the housing loan book because people wanted to take long-term fixed rates at the rates that were prevailing. SMEs also did well. You saw a growth. Only corporate segment was not growing in the first half. That I don't think is necessary because corporates are not borrowing, but corporates were demanding the fixed rates at the rates that were prevailing at the time. So we were not really willing to fix rates at those rates, knowing that the interest rates would go up. So we probably curtailed our loan book to corporate in the first half. So therefore, our corporate book didn't grow in the first half, but then in the second half, that has caught up with interest rates going up. So I think in 2022 also, I wouldn't think there would be just one segment. I think it will be overall growth. So fee income, there is no exceptional element there. It's just been that card transactions are low in 2020. One is probably there were not too many transactions happening. The other is the foreign transactions are not there. So foreigners were not there. But with both those improving and foreigners also now coming in, we have seen a substantial increase in the card operation. And even generally, because overall the economy was at a negative trajectory in 2020. So from there, you have seen it growing. So it's not an artificial growth or any exceptional item driving growth. Rather, it's growing from a lower base. So if there are no other questions, thank you very much, everyone, for participating for today's investor call. And we will meet you all again with our first quarter results. Thank you very much.